The broadcast is now starting. All attendees are in listen-only mode.
Good morning, everyone, and a very warm welcome to this spring update programme with the ICAEW West of England. My name is Stuart Price, and I'm a partner and pensions actuary at Quantum Advisory, and I'm with my colleague Dan Redwood, who's also an actuary but works in our investment team. So today we're going to talk about how financial markets have reacted to the COVID-19 crisis in respect of investments and also pensions. The presentation should last around about sort of 35 to 40 minutes, and there'll be a chance at the end to ask questions, which we'll answer. If you haven't got time to go through all the questions, then we'll try and answer your questions after the session. But again, on the panel there, you'll see hopefully there's a question box. Input your questions there, send it across to us, and then myself and Dan will try and answer those at the end. So what we thought we'd do is, first of all, tell you a little bit about Quantum Advisory and what we do. So we are an independent pensions and advisory firm. We have 5 locations in the UK. We have one in Bristol and also our head office just across the water in Cardiff. And essentially what we do is we help employers and trustees run their pension arrangements. We don't sell pensions, we work on the corporate side and help them run their arrangements. And you can see there we provide a wide range of services covering all aspects of pensions and employee benefits. So what are we going to go through this morning? Well, first of all, Dan's going to go through his investment part, and he'll take you through a summary of the events happening in the first quarter of 2020 and paying particular focus to what happened right at the end when obviously the impacts of COVID-19 really hit markets hard. They look at what's happened since then, though. Obviously, we've seen markets rebound a bit. And also then the outlook on maybe what a recovery will look like and what the implications could be for investments and the economy as a whole. On the pension side then, I'll give you sort of a market overview in relation to how that's impacted on pensions for defined benefit, defined contribution schemes, and looking how we can try and make sense of it all, especially communicating to our employees, and then some maybe longer term thoughts for the future in relation to UK pension provision. So what I'll do now is I'll hand over to Dan and he'll take you through his investment part.
Thanks, Stuart, and good morning, everybody. So yeah, as Stuart said, I'm just going to start off by taking you through a recap of the events of Q1 2020. And it does feel like an age ago now, but coming into 2020, markets were in a pretty good place. And there'd been progress in US-China trade talks, and then closer to home, we had a great deal of political uncertainty resolved as the Conservatives secured a pretty strong majority in December's election. And actually, Quantum, we upgraded our expectations for equities over the medium term, which is an assumption that hasn't aged particularly well. Because, of course, things started to change as it became apparent that the COVID-19 outbreak in China wasn't going to be confined and eventually became a global pandemic. The markets began to respond to this in February, but it was in March, really, that it became clear that large-scale economic shutdowns would be required, and panic started to set in as investors struggled to comprehend what the consequences would be for business. So on the chart you got in front of you, and this is tracking the performance of the MSCI World Index and the FTSE 100 over the past few quarters. And you can see pretty clearly in Q1 the impact. So the MSCI World Index is down 20.5% for the quarter, and the FTSE was down about 25% as well. But if you're looking at it from peak to trough, the falls are actually around about 35% for each index. So in terms of magnitude, that level of fall isn't that unusual for times of crisis like this, but what really set this time apart was the speed of the falls. So for the MSCI World, it was 20 days from peak to trough. And to put that into a bit of context, the previous fastest fall that we've seen was the 1987 Black Monday crash, where markets fell 33% over a period of around 75 days. And then you get events like the financial crisis in 2007 and 8, where it's a much slower process and markets fell around 55%, but it took about 400 days to do it. Now, mixed in amongst all this, another blow for markets was that talks between OPEC and Russia to constrain the oil supply in the face of rapidly diminishing demand broke down. And oil prices actually fell by more than 60%. So We even saw at one point futures price for WTI crude go negative as there was a global shortage of storage space for oil. And investors who didn't want to take delivery of the oil themselves were scrambling around trying to find someone who would take it for them. Now this position has rebounded somewhat, so we're looking at prices for oil, crude oil around $30 to $40 a barrel now. This is still some way short of January's level of around 60. And what this has meant is that the energy sector has been the most heavily hit. And this has obviously got consequences for the fossil fuel heavy FTSE 100 index. And we'll see later that when it's come to the recovery, the FTSE has lagged the rest of the world somewhat. Okay, on to the next slide then. Is that going? Great. So we've seen also that whilst equity markets have been obviously very volatile, volatility hasn't been confined to them. And I just wanted to touch on what happened in fixed income markets over the quarter. So we got some interesting things to note here. So the chart on the left-hand side here in red is showing what happened to the yield on long-dated UK government bonds. And so what we're seeing here is pretty consistent with what we often see at times of crisis, which is as investors are selling equities, they need somewhere to put their money. So they often will go for safe haven assets such as UK gilts. And this has resulted, as you can see, in a downward trajectory for yields, which run inverse to prices. So the yield on long-dated UK gilts started the year at around 1.2% per annum, and it's trended down gradually to a level of about 0.5, where it's stayed roughly stable since then. Now, to put this into context a little bit, actuaries have been talking for years about yields being at historic low levels. Can't go down much further, but this really is a new historic low. And it's actually in September, in the middle of the Brexit turmoil, that previous slide, that yields first dropped below, the 20-year yield on gilts dropped below 1% for the first time. So we're really seeing quite a big shift here. Now, that was generally what was going on, but you can see in the middle of the chart, it's not been plain sailing. And actually, at the peak of the crisis, there was a big fall in yields, as you might expect, but it was followed by a sharp spike. And actually, that spike was the biggest one-day rise. It was about 70 basis points, biggest one-day rise seen since financial crisis. Now, we've also got a similar effect seen in corporate bonds. So on the right-hand side, the blue line represents the spread on long-dated corporate debt over UK gilts as a measure of the excess that companies need to pay in order to borrow. And yeah, you can see another substantial spike, although not as sharp. It was a more gradual process from the end of February. Now, there are a few drivers of these effects, some of which are quite intuitive. But the most obvious, perhaps, is that obviously the nature of this crisis is that we've seen industries that are otherwise like perfectly viable, strong even, they've just had their whole outlook shift in the space of a few weeks. And that's obviously going to have impact on their credit ratings. So that will go part of the way to explain the spike in credit spreads. And credit, by the way, is another seen as a safe haven asset in times of volatility like these. So you don't necessarily see this that often. On the gilt side, around the end of March when the spike happens, the Chancellor Rishi Sunak had just committed to a vast amount of government spending. So I imagine the markets were concerned over whether they'd be able to absorb this level of issuance that was going to be seen in the coming months. The spike actually did die down once central banks stepped in to smooth conditions. There was a third factor though at play here. Now, what we also saw around the end of March was a scramble for liquidity as investors became concerned about cash flow. And asset managers in particular were needing to meet requests for withdrawals from their clients, but also in order to meet margin calls on derivative contracts. And they were finding that with markets in free fall, they didn't really have very much that they could sell. So they ended up sourcing it from gilts and corporate bonds, going some way to explain the spikes. What we saw was that really if the security wasn't issued by a sovereign, wasn't short dated or dollar denominated, typically it was selling off. And this carried some important lessons for investors, such as defined benefit pension schemes around cash flow management. That is, you don't want to be finding yourself as a forced seller in these environments. It pays to hold a bit of extra cash to cover your immediate needs. Okay, and I think now onto the next slide. So that's a quick summary of what was going on in markets. I think the onus was then on central banks and governments to step in. And they really did step in decisively, actually. So I've just summarised the actions that they took in US, UK and the Eurozone here, but there's a whole raft of measures taken globally. And this is divided into the monetary response carried out by the central banks. That was, and then also the fiscal response as well from governments. But the monetary response was two-pronged, really. So we saw interest rates cut, and in particular the UK, Bank of England cut rates down to 0.1%, which is another historic low. We also saw expansion in the quantitative easing programs that the banks are undertaking by each of them. And not only that, but they also widened the scope of the programs to move into asset classes outside of government bonds. So stepping into corporate bonds, among others, to basically guarantee liquidity in the markets and smooth out spikes like we saw on the previous slide. On the fiscal side, UK government stepped in with some really big measures. So 330 billion in government-backed loans. And then another key one on here is the furlough scheme. And these are all concerned with making sure that businesses remain solvent throughout the crisis and hopefully are still in place for a swift recovery once social distancing can be relaxed. Okay, next slide, please, Stuart. So that takes us on to Q2 then. So central banks and governments have responded decisively, and there was definitely a positive reaction from markets in response to this. And you see there's a really strong bounce in Q2. So MSCI World Index is up 15.8%. As I touched on earlier, the energy heavy FTSE 100 has lagged a bit, but still seen something of a bounce. Not shown on the chart, but the S&P 500 actually at points last week recovered all the way back to February's highs. So the recovery in the US has been particularly strong. Now, fiscal and monetary response has definitely been a big contributor to this, but perhaps markets are also benefiting somewhat from the certainty that economic data in Q2 is going to be appalling, and just deciding to ignore it and focus on the future. And it's definitely been positive responses now to relaxation of social distance measures that we're seeing. Although, personally, I feel that with the outlook for the virus still pretty uncertain, this does leave us exposed to quite a lot of downside risk. Worth noting quickly also, though, that you can see quite a sharp fall off at the end of last week. That's where the data runs up to. So we are still seeing some pretty significant volatility, even if the broad trend has been upwards. Yeah, next slide, please. It's worth also just looking under the bonnet here for a minute. So on this slide, I've separated out the FTSE All-Share Index into its component sectors. And you can see there's quite a wide dispersion between the sectors as to who's been worst hit by COVID. So obviously I've touched on oil and gas, and that is by far the worst hit. And these figures, by the way, they cover the whole of 2020. So it's looking at the initial falls, but also the subsequent bounce back. oil and gas, despite the bounce back, is still down about 36% for the year to date. Next worst hit, you've got financials and consumer services. So not too surprising here. So consumer services are pretty dependent on travel and leisure, retail, industries which have been basically suspended for a few months now. And then financials, obviously very sensitive to the UK economy here. It's not all been doom and gloom though. So healthcare, as you might kind of expect in a pandemic, has not fared too badly. So it's probably flat for the year. Then obviously the success story is the tech sector, and it's actually had a pretty strongly positive year actually. These figures are for the UK, but the same effect is seen globally, and it's a sector that's really benefited from changing consumer behaviour. So you can think of businesses like Zoom and Netflix must be doing pretty nicely. I mean, Zoom has gone from something that was only known by business to really being a household name. Even my mum knows what Zoom is now. But this does go some way to explain the disparity between, say, the US and the UK in particular. So we know the US is very weighted towards these tech stocks. So you've got your FANGs, so your Facebooks, Amazon, Apple, Netflix, Google. These play a big part in the US index, and they've really been driving that recovery. That in itself has been showing in the global equity index because it's such a large part of it. But the FTSE 100 itself is much more heavily weighted towards these oil and gas and financials. So that's really been the cause of the lag. Okay, and next slide, please. On to outlook then, and this is obviously pretty tricky. The future is very uncertain still, but what we do know is that the economic data in Q2 is going to be pretty appalling. So last week it was announced that the UK GDP fell 20.4% in April, which is the biggest ever fall, and we're going to expect to see a lot more numbers like this in the coming months. Now, going forwards, we're seeing economies, we've got the US, UK, Europe starting to move out of lockdown now. We've seen it done pretty successfully in countries like China and South Korea, but it's a big risk remaining over whether this can continue and whether restrictions will need to be reintroduced, potentially in response to a second wave, and particularly at risk here are the US and UK, which are currently running much higher case numbers than we're seeing in Europe. And of course, you've also got parts of the world where the first peak is yet to be reached. So in particular, we're looking at Latin America and parts of Asia, such as India, who are case numbers are starting to rise rapidly. And in terms of the outlook, it's really going to depend on how long these measures need to continue. And the longer they do, the more likely some form of structural change is going to be required, which may compromise the overall recovery. So summary here is it's still too early to make a solid assessment of long-term outlook. If we go on to the next slide, we'll see the way that we're thinking about the future, and you may have seen these used by other organizations, but we're looking at different scenarios for the future. And yeah, these all relate to the size of the global economy. I'm taking the first one, the V-shaped recovery. And this is our optimistic scenario. So obviously, seeing a sharp fall off in economic activity. The V-shape would then assume that the virus has been relatively quickly contained. And sorry, can we move back to the previous slide? That's okay. And then there's been a swift bounce back. And in this scenario, you'd expect risk assets like your equities to perform pretty strongly. And it can be argued that this is the scenario that the markets are currently pricing in most of the moment based on performance in Q2 to date. And as I mentioned, this does leave us with quite a lot of downside risk in the event that a second wave potentially takes hold and measures need to be reintroduced. That takes us on to our U or W-shaped scenario. And for us at Quantum, this is what looks most likely at the present time. So measures need to continue for quite a long time into the future. It doesn't seem likely at the moment that there's an immediate way out of this. There's no vaccine on the horizon. And Another risk here is that fiscal measures by the government are withdrawn prematurely, which could potentially, so anything really that could lead to widespread insolvencies and an uptick in unemployment is going to harm the recovery. And the volatility here for the W-shaped scenario would be very much news flow driven as markets try to get to grips with what the outlook is likely to be. We expect this to be a period of boom and bust for risk and safe haven assets, potentially as we're seeing at the moment, to be fair. And then most pessimistic of the lot is the L-shaped scenario. So this is your prolonged or no recovery over the next few years. I should say the timescales for these horizons are kind of the medium to long term, so looking over the next 2 to 3 years. And this is associated with a prolonged period of social distancing in force and accompanying business insolvencies that are essentially unavoidable at this stage, large-scale unemployment, as certain industries are basically unable to continue as they were beforehand. And around this, we'd expect to see a restructuring of the economy around the industries that are viable. And here it's going to be pretty slim pickings from an asset return perspective, but you'd expect your high-quality securities to perform relatively better here. Potentially safe haven assets as well, although with gilt rates where they are now, there's limited upside risk there unless rates were to go negative. Okay, moving on to the final slide. So what are the implications of this for investors? And I mean, this is something we've been saying for years, well, if not forever. Diversification remains key. If you're diversified by asset class, by geography, you probably would find that the impact of this kind of crisis is lessened. Within portfolios, we'd be looking at a focus on quality. Those companies that are have robust balance sheets and perhaps are able to be flexible to adapt to a new normal. Also, we'll be looking at investors trying to hedge out those unrewarded risks. So for pension schemes, this particularly means the interest rates and as linked to the gilt rates that I was talking about earlier, but also currency could be seen as an unrewarded risk. And then real assets where clients have or where investors have room to in their liquidity budgets, these can add security to a portfolio. So in next lesson, cash flow management, touched on this earlier, but you don't want to be that forced seller in a time of crisis. And then the final point here is about remaining dynamic. So this is, the volatility is going to present opportunities and risks, and really you want to be able to react to those. And as part of this, I think we're seeing it now. Active management is coming back into favour. So you're getting your investment managers to make decisions on your behalf, and they're going to start to earn their fees, hopefully, over the coming months and years. I think that's all I wanted to cover. Thank you.
Thanks, Dan. I'm sure there'll be some questions for you in due course. So I'm going to quickly now take you through the pension side and obviously COVID-19 and how it's really interacting with pensions in the UK. And first of all, I thought I'd just look at what it means in relation to defined benefit, defined contribution schemes. There's lots of things happening in financial markets. We've heard about gilt yields dropping and also investment markets falling. So what does it mean for pensions in the UK? So what I'll do, first of all, thought we'd look at defined benefit pension schemes or DB schemes. And before we sort of look into the detail, I thought we'd take a step back and look at what DB schemes are and how they work and remind ourselves. So defined benefit schemes, they are occupational schemes and only available via an employer. And the way they work is the employee and employer pay money into these schemes, but the money's in one big pooled investment. So the money just, all the funds are there to provide the benefits to employees. And what the benefit the employee gets is based on their length of service and their salary. So not what's paid in, but the length of service and salary. And what you've got here on this slide, this red formula, shows you how we work out someone's pension benefit and defined benefit pension scheme. It's predictable, hence why it's called defined benefits. You've got pensionable salary multiplied by the length of service, pensionable service, multiplied by something called an accrual rate, which is here is 1/60th. So what that means is that for every year in the pension scheme, that individual will be building up an annual pension of 1/60th of their salary. So keeping the math simple, if someone's got a salary of £30,000, they're in the scheme for 30 years, and it's a 60th accrual, then at retirement, they'll have £30,000 multiplied by 30 divided by 60, which gives them an annual pension of £15,000 per annum. Now, that pensionable salary definition actually decides upon what type of defined benefit scheme there is. There are two types. You've got final salary or you've got care schemes. And the difference in these two schemes is in relation to the definition of pensionable salary. In a final pensionable salary scheme, it's the last salary whilst working for the employer, while in a care scheme, it's an average of the salaries of your working lifetime with that employer. So generally, defined benefit final salary schemes give you a higher benefit than care schemes. Now, as I mentioned, these schemes don't depend on the contributions paid in because the benefits are guaranteed. And because they're guaranteed, the employer bears all the investment and mortality risks. So investments don't do very well, as we're seeing at the moment, then potentially it means that employers are going to put more money in. And mortality risk, if people live longer, it means their benefits are paid for longer, it costs more. And again, it's something the employer picks up the tab. So with these schemes now in the UK, you'll find they're less and less common due to these extra costs and risks. But there's still a lot out there, and so a lot of people who are reliant on defined benefit pension schemes. So what does it mean in relation to COVID-19 to these DB schemes and what's happened? Well, if you look at the top left here, the gilt yield, as Dan mentioned, gilt yields have dropped considerably over the last 12 months. They've come down by around about 0.8%. Again, it doesn't seem like a big drop, but a drop of that amount could mean that pension liabilities go up between 15 and 20%. Then if you look down to the implied inflation, this is the market's long-term expectations of inflation, and that's come down slightly over the last 12 months, and especially so since the COVID-19 crisis has hit. Now, pension schemes, generally pensions, what they come in payment, are increased by inflation. So if that comes down, then the value of liabilities will come down. But overall, though, that drop of inflation compared to what's happened to the gilt yields hasn't had a big impact. So all in all, we're seeing a huge increase in the value of liabilities on defined benefit pension schemes due to the impacts of COVID-19. And the bottom right-hand side, global markets, we've seen them drop considerably, as Dan mentioned, a bit of a bounce back now. But again, on the asset side as well, lots of pension schemes will be hit hard as well. So it's a double whammy for pension schemes. They've had an increase in their liabilities, a fall in their assets. Basically, that means that deficits are getting bigger and bigger at the current time. The top right-hand corner there is in relation to corporate bond yields, and that's a number that drives the value that's placed on defined benefit liabilities in company accounts. And again, that's been coming down over the last 12 months or so. So again, the number you put in your accounts in relation to your liability is likely to increase as well. So what does it mean on pension schemes in relation to the employee? So looking at the employee, in defined benefit pension schemes, well, as you've seen, the benefits they get are based on their service and their salary. So the fact that markets have gone down, gilt yields are going up, doesn't impact potentially on the benefits they're going to get at the end of the day. It only impacts them if their sponsor employer becomes insolvent and can no longer sponsor a defined benefit scheme. If that happens, then this pension scheme would stop. And the most likely scenario is it would go into the Pension Protection Fund or the PPF, the government lifeboat scheme run by the government for distressed schemes that have no employer. And the employee then would receive PPF compensation. The level of compensation though is pretty good. And the worst level you could get is 90%. So you get at least 90% of your benefits there. So again, for defined benefit employees, the impact on their benefits is really relatively small unless they've got a risk of their employer becoming insolvent. But what about a flexibility on how much they can pay in? Because obviously if these employees are currently on furlough, their pay is being reduced, maybe they're finding times difficult. Well, with these schemes though, there's not much flexibility as to what the employee can pay. Normally you have to pay what you're told to. There can be temporary absence provisions in the pension scheme rules, which allow them maybe to take a period of membership where they actually have like a holiday in the pension scheme, don't build up any benefits, but don't pay any contributions either. Or maybe an extreme measure would be that employees could opt out of the arrangement. But to do that, though, again, extreme caution should be taken because obviously with these schemes, they are the gold standard schemes, the best schemes you can get. And also they provide things like life insurance cover as well. So by opting out, there could be huge ramifications for the employees, and they'd be careful if they're going to opt out of these pension schemes. What about the employer? Well, for the employer, as we've seen, it's all to do with affordability. Over the long term, no doubt, contribution requirements may have to go up. But lots of employers are finding it difficult at the moment. Their turnover has been drastically hit, etc. Maybe in some sectors they've hibernated the company completely. And so legislation has changed in relation to DB schemes, and there's been more flexibility afforded. And what it allows is employers to actually take a contribution deferral for up to 3 months. And we're seeing a number of employers doing that, especially in the hospitality and leisure industry sector, obviously are high rating the companies at the moment. Now, if you want longer than 3 months, as things currently stand then, a lot more hoops have to go through, a lot more work need to be done by the pension trustees and the employer and their advisors. But, I do wonder personally that if you look at, the way we're coming out of this COVID-19 crisis, we've seen that in England now, obviously the retail sector is opened up yesterday, but still the hospitality sector, pubs, hotels, etc., restaurants, it'll be a bit longer before they can actually start to open up. So maybe there'll be some concessions for them in relation to DB schemes, and maybe they'll be allowed to have a contribution holiday for a longer period of time. So we have to wait and see that will happen, but I do hope that the pension industry will move and help give some form of protection for these sort of industries who need it most. What about defined contribution schemes? Well, these are now, by no doubt, the most common pension scheme you can get in the UK, because I mentioned defined benefit schemes are on the decline. So again, let's take a step back and look at how defined contribution pension schemes work. Well, again, in these schemes, the employee puts money in, as does the employer. But everyone here has their own individual ring-fenced account. The money's invested, and the idea being it grows with investment returns. So then at retirement, they have a pot of money to provide them with an income. In defined benefits, they're given a guaranteed income that are increasing each year in line with inflation and be paid to them until they pass away. In a defined contribution scheme, you've got a pot of money, you then go away and provide yourself with an income. So what can you do? Well, you can give that money to an insurance company. So they give you a guaranteed income, or something called an annuity. You can take the pot as a lump sum or a series of lump sums. Alternatively, you can do something called drawdown, where you keep the money invested and draw down it and provide you with income as and when you need it. But how has COVID-19 impacted defined contribution schemes? Well, no doubt, if you look at the bottom right, the biggest impact has been the fall in global markets, because in a defined contribution scheme, the benefits you get depend upon how the investments perform. So investments drop, the value of your pension pot, and hence the value of your potential income will fall. That's the biggest drop. But again, there are things that can be done to mitigate this. And for lots of individuals, again, it's not such a big issue, which I'll go on to in due course. If you look at the top left-hand side, gilt yields, again, they've dropped over the last 12 months, as I mentioned. And for DC schemes, this gives the impact actually on if you're going to buy an annuity with an insurance company. When gilt yields fall, it means the cost of providing annuity goes up. So what it means is you get less value for your money. So again, this is likely to mean that people are going to be less and less likely in the current state to go away and buy an annuity with a insurance company as they come to retire, and more likely do something on the drawdown or maybe on the lump sum route until maybe gilt yields come up and it's more cost effective to go away and buy an annuity with an insurance company. So what's happening for employees in relation to defined contribution schemes? Well, I said definitely lots of them would have seen a fall in their value of their pension pot, maybe 20-25%, huge drops. But the key thing to remember here is that for the majority of people, pension schemes are a long-term investment. For lots of people, they're 10, 15, 20, 30, even 40 years away from their retirement. So this is just really a blip on the journey. And hopefully it's just a short-term thing. And as we've seen from Dan's presentation, when the recovery will take place, markets will go back up to the level that they were at previously. So maybe you could say that is this a buying opportunity for people in defined contribution schemes? People think that markets are relatively low at the moment, and this is due to COVID-19, but things are going to get better in the future. And maybe now's the time to actually put a little bit more away in your pension scheme if it's affordable. I suppose the biggest impact is for those who are closer to retirement, because closer to retirement, you haven't got that time period to make up the falls that have happened in investment markets, and so the value of your pension pot could have been reduced. But generally, defined contribution schemes, what you have is the default pension scheme uses something called lifestyling. If you look at the graph here on this slide, the way lifestyling works is when you are younger, so you've got a long way to go from retirement, then you generally invest in growth assets, so things like diversified growth funds or equity funds that are actually going to give you growth over the longer term, but funds that are volatile and may be hit by short-term movements like we're seeing at the moment. But then as you gradually move to your retirement, as you can see here on this slide, then what these arrangements do for you is they move you into safer assets such as government bonds or corporate bonds and cash. Now, these investments will afford you some protection from the falls in markets, and therefore will those who are close to retirement would have seen a less impact on the value of their pension pots falling compared to those who are a long way of retirement. And then looking at affordability for contributions, again, for people maybe who are on furlough. Well, again, in defined contribution schemes, generally there's more flexibility because, employees and employers, they change the rates. If the employee pays a certain rate, the employer pays a certain amount, the employee pays a bit more, so the employer, etc. So generally, there's a flexibility to pay contributions at a lower rate up to a certain minimum. And the minimum under auto enrolment is 5% of qualifying earnings. So again, for defined contribution schemes, what we're finding is that maybe the employees have more flexibility compared to defined benefits in relation to what they can pay into the pension schemes. And defined contribution schemes, what about the employer? Well, again, they'll have short-term affordability issues. But again, in our experience, what employers pay into defined contribution schemes compared to defined contribution schemes is much, much less. In defined benefit schemes, employers are paying money in towards the future cost of providing benefits, but also making up deficits. So the amounts can be hundreds of thousands or even millions of pounds a year. Whereas defined contribution schemes, employers are paying a fixed amount in each year. So again, employers know what the affordability is for defined contribution schemes, and so they'll be less worried about the impact on pension contributions for these schemes compared to maybe defined benefit schemes. And also they've got more flexibility as to what they pay. So they can currently pay a minimum of 3% is what's required by legislation. And again, there's been more relaxation in relation to what contributions can be paid in defined contribution schemes, because generally in a pension scheme, if you're looking to change the rate of contributions being paid by the employee and employer, then you have to go through a consultation process of up to 60 days. But legislation has been eased a bit in relation to those employees who are on furlough. So if you've got employees on furlough, then again, the employer can push the contributions down to the minimum required under auto enrolment, which is 3% from the employee and 5% from the employee. And then again, once the employee then goes back into full-time employment, then the contributions then go back up to the normal level. So again, those are easements being put in place in relation to defined contribution pension schemes. So I suppose the question is, making sense of it all, and especially in relation to, I suppose, employees. Because if you think about it, yourselves on the seminar today, lots of you are financially sophisticated. You understand financials, you understand the markets, you understand the way pensions work. But lots of individuals out there, they don't understand, what's going on in relation to pensions. And I suppose over the last few months, maybe they've been thinking about job security and things like that. And now maybe they're thinking more about their pensions and what have been the implications for their pensions in relation to COVID-19. How has it impacted me personally? And so I think what we should be doing from both the pensions industry and employers is really speaking to our employees and communicating to them about their pension arrangements. And some of the things we should be doing, really reinforcing the points I've gone through earlier on. We want to maybe provide employees with reassurance that, for example, for those younger people, pension schemes are a long way off before they retire. So this is just a blip now, things will recover. And you're not retiring for 20, 30, 40 years time. So what happens now doesn't really have a huge impact on what you get at the end of it. For those in DC schemes that are closer to retirement, again, talking about that lifestyle, there's protections in place. So again, if you've got that in place, then again, that would afford you some protection and mitigating some of those recent falls in investment markets. And for those employees lucky enough to have defined benefit pension schemes, again, no impact on the benefit you'll get because, again, it's based on your service and salary. So in communications, I think the key thing is to keep them short and simple, quite snappy, but maybe highlight potential options that are available to individuals in relation to their own circumstances. And, what we're finding personally in relation to pensions is that those who have defined benefit pension schemes, we're finding there's been an uptick in the number of individuals who are asking to retire because maybe they realise that their benefits haven't been impacted and they want to live for today. They see what's happened with the COVID-19 crisis and the fact that, it can hit anyone at all. So maybe they want to take their benefits and try and enjoy their retirement, while they've got very, very good health. So we're seeing a bigger uptick in retirement from defined contribution schemes. But from defined contribution schemes, we're finding it maybe a little bit less as people are unsure as to what to do with markets being low. and maybe some people finding that they haven't got those protections in place. Maybe they didn't have lifestyling coming up to retirement, their markets have fallen, impacted their pension pots, and so maybe that means they're going to have to work for a little bit longer. So again, seeing quite a divide between defined benefit and defined contribution in relation to what pensions provide to individuals. And I thought I'd sort of end the session on just some thoughts for the future, and really think about longer term ramifications of what happened with COVID-19. Obviously, as Dan's alluded to, UK and global economies, will recover, but how long that recovery will be, we don't know. Will there be a second wave? We don't know how it's going to happen. But one thing for certain, though, we can see that governments have been pumping lots and lots of money into their own economies, and that money somehow is going to be paid back over some period of time. Again, the payback's going to be a long period, and it's going to be achieved somehow. And also, we've seen that some individuals will be impacted harder than others. Some different sectors have been quite immune to what's gone on, whereas other sectors are being hit very hard. Hospitality, leisure industry, people will be losing their jobs. How's that going to impact them in relation to saving for pensions in the future? So what's this mean for UK state pension and private pension provision? Well, what I've done is ended up really by just having some thoughts about, what could the impacts be? Well, if you take a step back, since 2012, we've had auto enrolment in place for the UK, where individuals are automatically put into a pension scheme as long as they're earning more than £10,000 per annum and are below the state pension age. Well, what we've seen is that the rates have been going up, and currently now employers paying 3, employees paying 5, but that rate of 8% is nowhere near enough really to pay a decent level of pension upon retirement. So in the pension industry, there's been reviews going on, government's been doing reviews, and we were hoping that those minimum rates would increase maybe in the short to medium term. But given what's happened with COVID-19 and the financial impact it's had on companies, I find that very hard for companies to be able to actually increase their contributions over the short to medium term. And what we may actually see is companies actually reducing what they pay into pension schemes to maybe so they can catch up with some of the shortfall that's impacted them over the last number of months. Then looking at the state, obviously the state's been pumping loads of money into the economy. It's got to make that up somehow, obviously by increasing taxes, national insurance. But things like the state pension, I can't see that being immune to changes as well. So what will happen? What can the government do? Well, they could reduce the amount of state pension that's being paid to individuals, or what they could do as well is a combination of, or in isolation, continue to increase that state pension age even further to 70, 71, 72. And can we see the end of the triple lock? Those of you who don't know, the triple lock is the way that the state pension increases. It increases by a minimum of 2.5%, increases in wages or increases in inflation. And what that's done, what's been in place, has put lots of state pensioners out of poverty. But again, it's something I can see maybe ending now because that costs billions of pounds a year to put in place. And again, something the government may have to reduce to try and claw back some of the money that they've been pumping into the economy. So what it means, I think, to me, is that, in the industry and for employers, we somehow got to try and encourage individuals to save more, which is hard given the fact that lots of people are in current financial difficulties, financial hardships, etc. And to me, the only way you can do that is communication, and education is the key. So, we've all got to try and play our part and help people understand, it's important to save for retirement. The sooner you can start saving, the bigger impact it has. And one thing that is going to be introduced is something called the pensions dashboard, and that will provide an individual, they'll log on their own details, and they provide details of all their private pension arrangements and also their state pension arrangement in one place, and what likely income they can get at retirement. It's been talked about for a number of years. It started to get off the ground, but it is being slowed up. And again, unfortunately, I do think with the COVID-19 impact, again, it's going to take even slower to introduce. But again, I think it's something we really do need to put in place. And by that, hopefully, it will make people realize they need to save more for their retirement. Because ultimately, I don't want to end on a sour note, but if we don't do something in relation to pension provision, we've got the COVID-19 crisis now. But I think in the medium to longer term, as a UK, as a country, as defined benefit schemes dwindle and die, and we have defined contribution schemes taking their place, and people aren't putting enough money in there, then I think we're going to have a huge problem on our hands in relation to people being able to afford to retire at a decent age once they reach the end of their working life. So again, I don't end on a sour note, but something we need to think about. But maybe that's maybe a task for another day once we get out of the COVID-19 crisis. So like to thank everyone for listening, and I hope you have enjoyed the presentation. And what we now would take is a couple of questions from individuals. And the first question I've got is one for Dan. It's a question actually not something we mentioned during the presentation, Dan, but is how does Brexit fit in with all this? What's happened with COVID-19, and we're hearing about, I suppose, the government at loggerheads in relation to Brexit negotiations. How does it fit in with markets, especially in the UK?
Right. You said to me at the beginning of the year that I'd do one of these presentations without making any reference to Brexit. I wouldn't have believed it. But yeah, it seems like there's still a great deal of uncertainty around there. I mean, what we do know is doesn't seem to have been a huge amount of progress with negotiations, but the government, probably despite having been given the best opportunity to extend the transition period without getting called up on it, has decided it doesn't want to anyway. So I personally wouldn't doubt the resolve of the government to get this done this year, and whether that means no deal or a significant change from the arrangements we have now, is probably not going to help businesses that are also already struggling to cope with the ramifications of COVID-19. So I think, thinking back to those potential recovery scenarios I was talking about earlier, I'd say for the UK, a bad Brexit outcome has to push us more from the U to W scenario towards that L-shaped prolonged recovery. It's just another layer of structural change on top of what potentially we're already going to have to deal with now. But certainly in the media, it seems to be taking a back seat, understandably. So perhaps we'll hear more about it in the coming months.
And one more question, Dan, maybe one you find a bit harder to answer, but are there any particular sector, asset class that appeals attractive, maybe especially to pension schemes? Are you seeing any sort of movement into certain areas where people think there could be an opportunity at the moment in relation to what's been happening with the COVID-19 crisis?
Yeah, well, it's definitely a lot easier to say where you don't want to put your money than where you do at the moment. I mean, I personally would be want to focus on, with respect to consumers, focus on the non-discretionary spending. I spoke earlier about looking at quality companies, and these are big companies with secure customer bases, and it's these companies that we're really seeing they've weathered the storm much better than the market as a whole, and I'd expect them to look better going forwards. And that would go for equity and for credit as well. I think for me, I touched on this earlier again, talking about active management. I would feel much more comfortable with my portfolio knowing that I had somebody taking those decisions based on company fundamentals, rather than just blindly allocating to an index at a time like this, particularly in the credit market where default risk is much higher than it was. But there are definitely pockets of value in credit, and potentially in equity as well, as the outlook clears a bit. Yeah, no, I think that probably covers it up. I should actually, no, the thing I was going to add actually was in response to this, obviously, when there's been a market crash like this, the worst thing you can do, if you don't need to, is start to sell your holdings that have fallen in price. So whilst we've not been encouraging our clients to go overweight equity, we certainly weren't recommending anybody sell, and even topping up to benchmark as they become underweight, to try and take advantage of the rebound, and that has served some well.
Excellent. I've also had one pension question in relation to, also I think maybe thinking about keeping employers' costs down. Can you ask employees to opt out of a company pension arrangement? Well, you can, I suppose, let employees know that they have that availability, because for some employees it could maybe be the best outcome for them, but they should need to be take careful consideration in relation to opting out. But it's not something you can coerce or you can promote, really. So it's just really something you can highlight. But again, then the individual will then have to contact their pension provider or the pension scheme to actually opt out the pension arrangement. Because as I said at the start, they're really opting out the pension scheme. It has other ramifications as well in relation potentially to life assurance benefits and things like that. So again, it's something to be very, very careful about if you are considering doing. I'm conscious of the time now, it's 11:15. We just say we could be about 45 or 15 minutes. And so looking at the questions, I don't think there's any more questions for me. Dan, any more questions for yourself?
No, not for me.
Okay, so I'd just like to say, thank you for everyone listening. Obviously, thank you for the ICAEW for giving us the opportunity to speak to its members in relation to pensions and investments. And obviously, our contact details are there on this slide. So if you have any investment or any pensions questions you'd like to direct our way, then please do feel free to contact us. Otherwise, I wish you a fruitful rest of the day, and hopefully see you all again soon sometime. So thanks very much.
Thank you, everyone.